GE stock has been absolutely destroyed in the last couple years. In 2016, their stock performance was relatively flat, but in 2017, their price decreased by around 45%. Year to date in 2018, their stock is already down another 30%. So we're really talking about a stock price that was well into the 30s just about a little over a year ago and is now in the low teens, dropped by more than half of its value and currently sitting at around $12 a share. So this is absolutely horrible performance in what has otherwise been a very strong bull market. And so a lot of viewers have mostly been asking me three primary questions. Why did GE stock crash? Will it ever rebound? And when would it be a good time to buy? All great questions. Let's get started. What's up, everybody? My name is Ale. Welcome to my world of finance. Now, I was going to read to you guys the company description for General Electric, but then I realized that it was like 30 pages long, so I think I'm just going to summarize it instead. Now, throughout recent history, they've operated through some major segments like power, oil and gas, aviation, healthcare, transportation, appliances, lighting, and GE Capital. Now, I'm not going to go into a lot of detail with each of these segments, but to give you a rough idea, General Electric has done a lot of work with power generation, and equipment, and then selling that equipment or energy to governments and even commercial and non-commercial entities as well. And I believe that about 1/3 of the world's electricity is estimated to be generated using GE technology. So that's pretty massive. Now, when looking at products from some of their other segments like aviation, appliances, and lighting, that will consist of things like massive jet engines and equipment that they can sell to commercial airliners or even militaries. But they also have much smaller stuff like consumer appliances. So think of things like refrigerators, washing machines, ovens, and then even much smaller stuff like lamps and even light bulbs as well. Now, when looking at healthcare, that definitely consists of different equipment that is used in that field. So think of things like scanners, imaging systems, x-ray machines. They even do a lot of artificial intelligence stuff, so all kinds of stuff like that related in that healthcare field. And then there's GE Capital. So just like you might assume, they do a bunch of financial work. So whether that's giving out loans, credit, working with real estate, or even financing operations, or helping some of their consumers finance purchases of GE products, all of that would fall into GE Capital. All right, now why has GE stock dropped by such a massive amount? Well, the thing that you have to understand is that GE is this huge company, so such a large drop in price is not going to just happen overnight or just with a few little mistakes. There is literally an entire history of massive mistakes that this company has been making for many years. In fact, a lot of blame often gets placed on their old CEO, who his name is I believe it's Jeff Immelt. And he was hired back in 2000, and then he retired actually just last year in 2017. And so under his leadership, GE relied too heavily on their GE Capital segment, which actually took a massive hit during the 2008 financial crisis. They did eventually rebound with investments in oil and gas, but they got hit once again once oil prices dropped. Now, GE has also been accused of making some very horrible acquisitions at horrible prices, selling assets at horrible prices, and even buying back stock, again, at horrible prices. And on top of all this, the company has really seen some pretty bad performance from some of its biggest segments. In fact, when looking at GE's revenue from 2017 divided into their different segments, you can see that power made up the biggest portion of revenue, but the problem is that power also accounted for their biggest drop in revenue and their second biggest drop in profit year over year, only behind their GE Capital segment, which actually lost close to $7 billion. All right, now I got these numbers from GE's 10K. I'll have it linked in the description below, along with some other sources in case you want to do some really boring reading. But when looking at profit, so we're looking specifically at profit here year over year from 2016 to 2017, their power segment dropped by almost half, with a drop of almost $3 billion. So some of these drops are just a really big deal. And even their other segments weren't doing so great either. When looking at renewable energy, that was barely up, but it's also one of their smallest segments, so it wasn't very significant. And then when looking at oil and gas, transportation, and lighting, all of those segments were down by significant amounts. Now, on the bright side, aviation and healthcare continue to perform well, but they weren't enough to make the company profitable. In fact, when looking at GE's income statement, we can see that net income has been up and down for the last few years. They had positive earnings in 2014, negative in 2015, positive in 2016, and then back to negative in 2017. On top of that, when looking at guidance for their power segment profit, they just lowered it recently in their last quarterly earnings by $500 million for the rest of the year. So it's really expected to get worse before it gets any better. So then we're brought back to the question, can GE turn things around? Well, I think it really depends. What you have to understand is that GE is in a huge transitional phase right now. Their old CEO retired last year in 2017, we just talked about that, so now they're under new management with a brand new CEO by the name of John Flannery. And so under this new management and new leadership by a new CEO, they're making some drastic changes. In fact, one of the biggest criticisms of General Electric has long been that they have too many segments. Okay, we talked about all their different segments. They had too many segments that were operating in vastly different industries, so they weren't closely related enough. So this was really a company that was trying to make imaging and artificial intelligence equipment for their healthcare segment while working on railroads and transportation equipment. And then when working with power generation, they were still making appliances like refrigerators and washing machines. And then while building and engineering massive jet engines for huge airliners and militaries and things like that, they were giving out loans, credit cards, and I think at one point they were even working with pet insurance. They were even giving out pet insurance, pet insurance. So GE was just spread out way too thin, and the argument was made that management wasn't focused enough to help these individual and very different segments thrive on their own. And so the result now is that General Electric is selling off many of their assets and spinning off other segments. Now, if you've never heard of the term spin-off in kind of business talk, what it means is basically taking a segment like healthcare and basically separating it from the parent company, which in this case would be General Electric, and turning it into its own new separate company. And there's actually a lot of different ways that you can go about doing that, and there are also ways of attaching some of your parent company's debt to the new company, and that way lowering debt for the parent company, in this case General Electric, which is actually one of the things that we'll talk about in just a second. And so the end result has been that GE sold off their appliance business to Haier, I don't know how to pronounce that, but that was back in 2016. Their transportation business to WaveTech back in May. They spun off their oil and gas segment with Baker Hughes, which is considered to be a GE company, but I believe that GE plans on exiting their position in the next couple years. And on top of that, General Electric has been trying to shrink their GE Capital segment ever since the financial crisis. And when it's all said and done, GE Capital should consist mostly of just being a leasing unit for aircrafts. And even though GE Healthcare has performed very well for them, they are also planning on spinning off 80% of that segment into a separate company, along with roughly $18 billion of debt from pension obligations. So we talked about attaching some of that debt earlier, and then monetizing the remaining 20%. And so the belief is that GE can really help these different segments thrive on their own. In this case, healthcare, they believe that healthcare will be able to actually perform better as their own entity, as their own company, while GE can focus on some of their other core businesses. Oh, and one last thing I forgot to mention, they are also planning on selling GE Lighting, but I believe, to my knowledge, don't quote me on this, but to my knowledge, I believe they haven't been able to find a buyer so far. But basically, in the end, John Flannery is looking to create a much more focused company comprising of a core business of really only 3 primary segments. Those being their crown jewel aviation segment, which continues to perform very well, their renewable energy segment, which hasn't performed amazing, but does have a lot of potential for future growth in the future, although it is technically their smallest segment now. And then finally their power segment, which would be their largest segment and also their most struggling segment. So that could pose some challenges. So then if we come back to the question, when is the right time to buy GE stock? I'm really left with a couple different thoughts. Now, when looking at their different segments, power is their largest one. Aviation will have a much larger slice of the pie now that they're kind of shrinking their business model. But I don't know if aviation is enough to really carry the stock. In fact, in the past, aviation has performed very well, but the other segments really dragged it down. And in this case, their power segment is really struggling. Now, they do have renewable energy and there's a lot of potential there, but that could take several years until we see very significant growth from that segment. And so that really leaves me looking at their power segment being the most crucial point of their business to really help them turn their stock around. Now, it's no secret that they've been selling off many of these assets. They've been spinning off some of their debt. So they should be improving their balance sheet in the future, and it's one of their main targets. What that tells me is that they should likely have a lot of cash in the future to reinvest into innovation and help them grow that power segment. So that could be a potential upside in the future. And on top of that, many analysts are speaking to the fact that GE is a much more focused company now with segments that are more closely related that can actually share R&D with each other and benefit each other. So when talking about R&D, that just stands for research and development. And when looking at GE's booming aviation segment, they use engine turbines and ceramic materials that actually came from R&D from their power segment when looking at gas turbines and different things that were used for energy production. So shrinking the core business to only a few different segments that are much more closely related, that use a similar business model, that can share similar technology, that can actually help cut expenses, improve profit margins, which have actually been shrinking, create more innovation, and ultimately provide the growth needed to turn the company around. But will all of that actually happen? I have no idea. I mean, this is a company that was horribly mismanaged for a very long time. And even when looking at their most recent quarter, their power segment had 26% less orders than the year ago quarter, revenue declined by 19%, and profit was down by 58%. And then John Flannery, their new CEO, he stated that their power segment is, quote, an asset worth protecting, but will be a multi-year fix. And on top of that, GE is really a dividend company. And when looking at their track record, you can see that they actually had to cut their dividend in half last year, which really didn't please investors at all. So with a smaller company that has its biggest segment struggling and being called a multi-year fix, a dividend that was cut in half, a stock that nobody seems to believe in, I'm left wondering if there is any good time to buy this stock, at least anytime soon. But on the flip side of that coin, you could make the argument that GE is a blue chip dividend company that was horribly mismanaged for a very long time, made some horrible mistakes, lost more than half of its value, but now under new management and under a new CEO, they are much more focused, their segments are more closely related, they can share innovations and technologies together. They are selling off assets and shrinking debt to improve their balance sheet in the future, which maybe will equate to more sustainable dividends, and maybe they'll be able to invest in innovation and future growth. And so if you really look at it that way, then seeing GE at these prices with a discount of more than 50% may sound attractive to you. But how I personally feel about all this is that there are other stocks out there that are safer than GE and they offer just as much potential. And so even if I have to wait just a few quarters to see if management can actually start to turn things around, I don't think that I would be missing out too much on the share price. I really think that General Electric is going to be a multi-year turnaround. I think it's going to take a lot of time and it's going to take some drastic changes and some innovation and some growth for them to really turn around. So what I really want to see is some evidence of their power segment improving. I actually want them to be raising guidance, not lowering it. So I think I'll just wait a little bit longer. And if I miss the boat, then I missed the boat. I'm sure a lot of people will remind me of this video if the stock just surges later on. But at the same time, if the stock drops a little bit lower, I may be able to get an even better price than what is being paid right now. And I'm just not convinced that the risk is worth it given their recent performance being so poor. Now, I do think that they have pretty good new management. I like their new CEO. He seems sincere enough. I do believe that they are more focused and that they are working really hard to turn General Electric around. I'm just not convinced that it's going to happen this quickly. And given the recent performance, I'm not convinced that the risk is worth it, at least not quite yet. But who cares what I think, guys? It really matters what you guys think. So make sure you leave a comment down below. Let me know how you feel about General Electric. I know that this is a very polarizing subject. I know that some people are really bullish on General Electric because of what they were in the past and how much they've been beaten down. And a lot of people will make the argument you got to buy low, you got to sell high. So that all kind of fits in with General Electric. But then on the other side of the camp, a lot of people are saying don't catch a falling knife. This stock is, this company is horribly mismanaged. It's probably going to continue to drop. And so a lot of people are just really arguing, and they're very passionate about General Electric. So anyway, let me know what you guys think. I'd love to hear your comments down below. So thank you so much for watching. Don't forget to support the channel. Hit the like button if you enjoyed this. Make sure you subscribe for all type of related stock market content. And I will catch you guys in the next video. Have a wonderful, beautiful day. Take care. Bye-bye.